Okay, everybody, it is 1 o'clock and we will now get started. My name is Ian Campbell. I'm Vice President of Operations at PACICC. I am the staff lead for the Risk Officers Forum, and I'm your moderator for this afternoon's broadcast. I want to welcome everybody to today's broadcast, and a special welcome to first-timers joining us here today. This is our first Risk Officers Forum event of the year in this continuing nightmare of COVID-19. We have more than 140 participants joining us here today from 65 organizations across Canada, so welcome everybody. I want to thank my colleague Danica Hall, Manager of Operations, for her work behind the scenes with slides to help ensure a steady broadcast this afternoon. Danica, you might want to use speaker view as we go through the broadcast. I'm not sure if you're able to do that, but maybe we could employ that from time to time. I want to encourage everybody to just relax and enjoy the next 90 minutes. Don't view this as another boring webinar focused on technical industry issues. Instead, please use your imagination. Think of us as the top-rated insurance talk show in Canada, featuring fabulous guests and zany insider chit-chat. We have a very exciting agenda ahead. I'll ask Danica to flip that up, the second slide. So I'm going to begin with some housekeeping items. Then we're going to have a welcome from our CEO. I'll introduce our industry discussion panel. We'll close the broadcast with discussion of some upcoming events on April 1 and May 19th, and then enlist your help with our satisfaction survey that we always follow up the broadcast with. So in terms of housekeeping items, we are using the MS Teams platform, and I want to go over some ground rules to make this a more productive meeting for everybody. Thanks for muting your audio and disabling your video. We do invite questions throughout the broadcast to make this more interactive and conversational, and less so than a presentation. So certainly invite you to raise your hand, use the icon in the taskbar, and we'll recognize you. We'll ask you to turn on your audio, turn on your video if you wish, pose your question or make your comment, and then mute yourself again. And we invite your questions and comments throughout the broadcast. I've told our presenters that they are more facilitators for discussion, and this isn't so much a presentation format, but just a chance for them to share their ideas in a very competitive industry, and then you can add your own. We certainly do welcome that. So today's broadcast is a conversation with insurers regarding risk identification and risk assessment. We've begun the last 2 years with this topic, and our satisfaction surveys have shown there is very strong industry interest in this issue. Antitrust compliance rules the day. The Competition Act remains in force. There is to be no collusion, no common approaches to business strategies, claims adjusting practices, scopes of coverage, resolution of mixed claims, and/or management of third-party vendors and service providers. The meeting is being recorded for future on-demand rebroadcast and is going to be placed on our website shortly. And this is certainly helpful to members unable to join us here today. I'm going to now call upon, flip my page here, begin by saying hello to PACICC's own James Brown, the hardest working man in the P&C insurance industry, our president and CEO, Alistair Campbell. Earlier this week on Monday morning, Alistair had been asked to help facilitate an international gathering of insurance guarantee schemes focused on policyholder protection measures in Europe, and he gladly accepted the call. And then he was told that the meeting would begin promptly at 4 a.m. So a little bit of a surprise, but he handled it very capably. So over to you, Alistair, to provide some brief words of welcome, and then we'll move to introduce our panel.
Thanks for the very kind intro, Ian. I get to do a second day of that workshop on Friday. So another full day starting at 4 a.m. Builds character. Europe has been wrestling with a wave of insurer failures. And so as a result, there's particular interest in the merits of insurance guarantee schemes in Europe. So that's the policy work we've been helping them think through officially in Frankfurt, but in 23 member states, no longer including the UK. So just really quickly, a quick PACICC update as we enter this year. Last year, we were engaged in a very complex dialogue with the industry around the idea of a resolution protocol, possible use of tools by PACICC that were within our bylaw authority to help avert failure, tools that had never been used and authorities that had never been exercised. It was actually a perk of COVID that we ended up having a better and more engaged industry dialogue than we might have otherwise got. We got to meet the CEOs when we needed to talk with them. We had a fantastic workshop at North Winds in the fall that got 35 C-suite level folks. An IBC special committee was struck to give us feedback. And the net result was we actually produced a unanimously adopted protocol by our board with industry support, which would see us using tools hitherto unused to avert failure in support of the broader interests of the industry. Fascinating exercise and a very positive outcome for the year. This event today is really part of a series that we have been building out over a decade now. What does PACICC do in a time of peace when there's no insolvencies? And the first and most logical thing to engage in is helping spread best practice in enterprise risk management across the industry, large company, small company, regional company, national company, personal lines, commercial lines, specialty. This series of risk webinars and risk officers fora has turned out to be a very effective way for us to achieve that objective. At the end of the session today, you're going to see the benefits and value you can get from attending these sessions. You will also see the carefully curated series that we've got planned for this year. None of them are to be missed. I feel really good about the work that Ian has been doing with our Risk Officers Advisory Group to build out a really great agenda of webinars and meetings for the year. So thanks for joining us. Just quickly on the PACICC plan for this year. Our primary objective this year is to execute comprehensive desktop simulations with OSFI and with the AMF. The honest truth is there's no one here at PACICC today who was working here when the last company failed in Canada. And increasingly, that's also the case in OSFI and the AMF. So the institutional knowledge has eroded. The institutional muscle memory is not what it was. And so in lieu of actual failure, what's our best route? Our best route is to do practice simulations as close as we can get to live fire drills. And so those two exercises this year are going to, I think, really help inform where we need to upgrade our capabilities, enhance our tools, and think better about what the next failure is going to be like in a very different dynamic than the ones of 15 or 16 years ago, including the challenge of managing public and consumer concerns through social media. Last point, just quickly, the number one file for PACICC remains the risks associated with systemic contagion after the quake, the big one, BC or in the Montreal-Ottawa corridor. It remains a very frustrating gap in the kind of public infrastructure of Canada that our country remains uniquely unprepared for a major tail risk event. We continue to believe and advocate to the federal government that the lesson of COVID, if there is one above all, is that it's a good idea to have a plan in advance for tail risk events. We are making some very good progress in that dialogue with Finance Canada at the moment and are very optimistic that in the course of the year, we will be able to move that file forward quite a long way. So that continues to be an obsession of this organization through thick and thin until we get to a much better place. Now to the agenda of today. Ian, I throw it back to you, but in advance, we'd just like to say special thanks to our very brave volunteers who've agreed from big company and small to help all of us think better about identification and assessment of new, emerging, and evolving risk. Ian, over to you.
Thanks very much, Alistair. And I want to thank him. That's a great opportunity to update you on the priority issues, the work on priority issues that PACICC is making. So we certainly do appreciate the check-in by Alistair. So now introducing our industry panel, I'm going to ask our panelists to activate their videos. Our first panelist is Maz Bown, Chief Risk Officer for Aviva Canada, Inc. And we have John Lewis, Chief Executive Officer for Fenchurch General Insurance Company, and also Andrew Yorke, Vice President, Enterprise Risk Management and Chief Risk Officer for the Cooperators Group Limited. So if you could all please activate your videos. I can't see faces here.
Hi, Ian. You probably need us to talk to appear.
There we are. There's one. Yep. There's Naz,
yes, okay.
and I need Andrew and John to.
I think I'm on.
And we're over here, Ian.
Yep. Okay. There's Andrew and John. Okay. Perfect. Okay. So everyone has seen the list of questions. I circulated those earlier, and we've had a little discussion amongst the panel about questions that they would feel that they could jump in and answer right away. No problem. So I'm going to go with questions that the three panelists have all said I'd be pleased to jump in and answer that. We categorize them in terms of sources of risk, specific risks, process, strategies, and approaches, and also observations. So under sources, let's go to the panel and ask you how and from whom do you get risk information in your organization? And I also want to ask people out there, after you've heard from our panelists, if you have questions or comments as we go question by question, please by all means jump in. And if you have an answer you'd like to share, if that question was posed to you, we certainly would appreciate your input as well. So again, for our panel, how and from whom do you get risk information in your organization? Maybe we'll start with Maz.
Thanks, Ian. And first of all, I'd just like to say it's great to have this opportunity, so thanks for inviting me. And also, it's a shame that we can't do it all in person. I am missing the biscuits or the cookies or whatever it is that we would normally be having. And it's always much better to be able to have these conversations face to face. But this is a great next alternative. In terms of risk information from the business then, so first and foremost for me it's about leveraging the subject matter expertise that we've got, and it resides in the business, in the first line teams. You know, they've got their fingers on the pulse in terms of, you know, what's going on for them, what the data is on the trends, emerging areas of challenge, what they're seeing in the market. And so, you know, and we're reinforcing the message regularly that risk is part of everybody's work every day. It's part of good business management. It's not a separate thing. And so we tap into our teams very regularly, because 4,000 heads across Aviva Canada is better than 20 of my risk team. Even though my risk team are fabulous, we can't cover everything and be everywhere all at once. So that regular risk partnering is a really key part of how we get our risk information. There's loads of other potential sources, but I'm going to stop there and let some of my other panelists chip in.
Okay, maybe John and Shafeen, we have your video on. Could you eliminate your video and we'll just have our panelists on? Thank you. And so let's go to John, please.
Thank you, Ian, and thank you to you and Alistair and Danica for arranging this and having it in. It's a real pleasure to be able to meet with people, even if I still remain within my own living room here. So I would agree, of course, with Maz in terms of sources of information. Now, being the smaller company on the panel, of course, we do also get a little more of our information coming from external specialists who we work with, our actuaries, our auditors, groups in our claims outsourcer that we deal with, as well as, of course, monitoring the various news feeds and information that comes through there. So that kind of supplements a bit on top of the direct interaction with our distributors and the folks on the front line.
Okay, and Andrew?
Yeah, thanks for having me as well. And this is actually a momentous occasion for me because this is the first time I've been in the office in about a year. So I just wanted to make sure I didn't all of a sudden cut out in the middle of the presentation. But for us, I would say the same thing as Maz. We use internal sources across the organization. We're looping in with various departments, products, and whatnot. I think the biggest thing I would highlight is that we really try to ensure there's a tight link with strategic planning. They do an enterprise scan, and we want to make sure that that risk and planning aspect is really tightly correlated. And so we work hand in hand with them. And then, as the others have said, I mean, there's just a ton of external sources of information on risk. And so we leverage, whether it be PACICC here or GRI or RIMS or McKinsey or whatnot, there's no shortage of information out there.
And I
So
think that's one of the challenges, Ian, and because there is so much information that is potentially available to us as risk teams, and as risk officers, and to our board as well in terms of what they're looking at and reading. And one of the things that I'm massively interested in and haven't quite yet seen a solution for out there is an automated scanning approach of all of the information, basically a download of the internet. What's the trend? What's happening? What's emerging? And understanding whether that might have an impact to our industry, and therefore being able to think about taking appropriate action. It's something we've been thinking about and playing with in Aviva, but it's really tricky to do. But there must be an opportunity for an insurtech or a fintech to build something in that space.
This goes back to when we first offered this, the focus on emerging risks and risk identification, risk assessment. Susan Meltzer was our Risk Management Advisory Committee chair at the time, and she said it's really important for the industry to consider the black swan issues, the issues that people aren't looking at right now, that we should always be scanning the horizon and looking for the next brick in the head that's going to hit the industry. And so to that end, the second question, what sources of information for scanning the horizon for the future emerging risks do you use and would you recommend? If for people out there, what are some must go places that they should be looking for information? And I do respect the fact that it's a very competitive industry and there are things you may or may not want to share, but are there things you can offer up that would be helpful to people out there?
I mean, for us, I don't think there's anything that I'm not willing to share, because it's pretty much along the lines of what I mentioned. It's all sources that I think a lot of people are familiar with. Information from the Big Four, from some of the big consulting firms. I certainly have used McKinsey's had a lot of good publications, GRI, RIMS, CRO organizations, tons of general media. And I think, as Maz said, it's really a matter of distilling it all rather than looking for more competitive advantage type sources of information.
I think one of the things that we're trying to do is trying to devote more time to looking outwards and looking forwards, because I think particularly in 2020, we've necessarily needed to focus inwards and actively, work on the pitch, managing the risks that we were facing during COVID. But I think, I'd love to spend more of my time looking outwards, but it's about how do I prioritize that time in terms of picking the right topics to focus on. That's quite a challenge. But as part of that, what I'm trying to make sure I'm doing as well is broaden my interaction by getting involved and listening into webinars or forum industry forums that are outside of what would typically just be risk or actuarial, which is my home, as it were, my heart. I'm trying to attend more CISO type events and some data governance or data officer forums, just to try and hear what's going on in their spaces, to see if I can anticipate a little bit better. I understand, but then anticipate how that might impact on what we're doing. So it's trying to cast the net beyond what would traditionally be a risk input.
Okay, John, do you want to, or?
Well, I was just giving some thought to the whole black swan question, I guess, Ian. A lot of these black swan events somewhat exist within your portfolio today. It's just the event that triggers it. And so I think about the recent pandemic and some of the language and contracts. I think about the asset issues in the 2008 mortgage crisis. These are things where we already had the bomb in place, and it was a question of how you were going to recognize that in advance. And it's the same sort of problem that, of course, Canada had with COVID, where we used to have an agency that monitored. As Maz was saying, you need a big data approach, something like the CB Insights team does, to monitor the big data, identify the trends, so that you can then link it up to what's happening within your own portfolio and your own exposures. It's a very interesting piece of the risk world to be able to look outside of the everyday and say, what am I not anticipating here in the world?
I just had one of our viewers, Sonia Kundi, noted that the World Economic Forum just released their 2021 Global Risks Report, and that is a very good source for information. So that's very helpful. Thank you, Sonia. So people noted that the value in looking everywhere, all points of contact for information on risk issues. Do you see value in surveying internal employees and or external partners as part of your emerging risk identification process? Maybe John, you want to begin with that one?
Sure, yeah, absolutely. Now I'm of course blessed with a smaller organization, so I'm able to speak to most of the people directly to do surveying. We do some formal surveying around a variety of topics as well, but getting out and speaking with the people who are selling the products, adjudicating the claims, running the systems, they have different views on the world from you, and they will also be able to identify risks that you may not be thinking about. The other group that is interesting, as I think Maz mentioned, is of course the directors. And while they are not necessarily as close to the risks, they know the right questions to ask about them, and they can help you to clarify some of your own thinking as you're looking at your book and your portfolios.
Yeah, I'd agree with that. I find it absolutely fascinating, the perspective that the board brings, and rightly so, that's why they're on the board. But you know, the breadth of experience and the fact that they are exposed to different industries through their past, but also their other board engagements. They bring a lot of very insightful challenges and questions, and from a completely different angle at times that just hadn't occurred to me or to our conversations in the business, and give us good food for thought. We are also using, you know, a quarterly workshop process where we meet with key folk in the organisation, because as much as I'd love to use an actual survey tool, I actually really value the free flowing conversation, because, you know, people play off of each other, and, you know, and we get an opportunity to explore the topic in a bit more detail. And there's a bit of survey fatigue at the moment, to be honest. So I'm not sure whether I'm going to go down that road. The thing that I was quite curious about, and I'd value contribution from folk out there, is surveying external partners, whether that's your supply chain or your distribution partners. And that's not something that I've previously done, and I'm quite curious as to you know, experiences that people have had with that.
And just to join in, somebody had asked as a tail end of this question, if maybe you expect this in larger companies, but if you are surveying, is it a formal survey that is sent to external partners, to internal employees, and how often is this done throughout the year?
Yeah, well, I was just going to say, for ourselves, this question made me pause on our own program, or like pause and consider, that is. We're not currently formally doing surveys, so I took this as a way as something to think about. Is there something we could leverage there? And actually, also to Maz's point, we're not currently engaging significantly on emerging risks to our board, and our board as cooperators is actually a very diverse member organization group of coming from a wide range of industries in Canada, so there may be value there as well. But our current approach is really more sitting down with leaders across the organization. We have risk advisors associated with all of our top risks, and risk champions for each of the business units. So it's more getting in front of them and having that more conversational element, and taking it where it goes, and leveraging them, because they're the experts that have the best knowledge of the risks that they're faced with. I just add on to that we do have a working group that we've established, and we meet twice a year, and that's 15 to 20 people at the VP, AVP, manager level from various parts of the business, and so we have a bit more of a structured conversation there in addition to what I've mentioned.
I don't know if some of our viewers want to chime in here. Are you doing these surveys? Are you finding them helpful to your organizations? If anybody has comments on that, certainly put your hand up, we'll recognize you and love to hear from you. But if not, then we will go on to our next question. Okay. It's a question on observations here. What should insurers be doing to promote the role of risk management across all functions of your organization? What's been your experience?
So for us, I think I mentioned it briefly earlier, but the key thing is that communication and regular communication. Actually, I think it's quite easy for it to get lost in the noise of the day job. Otherwise, that risk is part of everybody's day-to-day work. We are in the risk business, and every decision, every action that somebody is taking during the course of the day is in some way in relation to a risk that they're managing or mitigating. And so just reminding them that risk management is actually part of what they're doing, and that it's important is something that we've been trying to put quite a lot of focus towards. It's not something separate. And then related to that then is having that clarity of responsibility and accountability as part of a goal setting process, so that we can reflect on that over the course of the year in performance conversations to make, to bring to life that it's about the performance of the organization, but risk management is an equal part of making sure that we are a success for our customers and our stakeholders. And more close to home in terms of the risk function, one of the things that I'm really passionate about is enabling people to move in and out of the risk team, and to bring people in to experience life working with us in the risk function, to see our perspectives and to take that thinking back into their day job, maybe 3 or 6 months later, or even shorter. It doesn't worry me either way. But also within the risk team to bring that expertise and that thinking of the current processes and the current product development or whatever into our team, so that we keep current. And I find that we need to do a bit more of that in terms of encouraging people to experience the risk function and see things from a different perspective, to help them do their jobs better.
Yeah, and for cooperators, certainly we'd say, it's really about building that risk management into your risk culture in the first line of defense. We have a risk appetite framework that is pretty robust, and it's well known at executive management level. It's well known at the risk committee level of the board. But one of the things I observed in my first year in this role was the need to make sure that it's in front of everybody in the business. So it's one thing to have a piece of paper that you have done, but if it's not well known and all the way through the organization, that doesn't really mean much. So that's one of the things I've charged my team with, and I've actually already had a couple meetings earlier today or yesterday on that, is getting in front of the VPs and their teams, walking them through what that means, and bringing it to life for them. I think the other thing that I see in the future, we may not tackle this year, is also making it part of the onboarding process so that employees are exposed to risk management views and a way of thinking from day one.
Completely agree with that, Andrew. And also making sure it's clear as part of handover between people as they move from role to role, whether it's onboarding or just changing in the organisation. Your risk accountabilities are just as important as your actual job accountabilities. Not that they're separate, but you know what I mean.
Yeah.
It's interesting. So companies definitely have cultures, and they definitely have focuses on them. And in the 3 companies that I've purchased, risk, I can say, was not a core focus for them, and which is very interesting because our core business is pricing and taking on risk. That's what we're in the business to do. And it's essential that all the employees understand the risk parameters in their job and the type of risks that they're responsible for and can take. And so in each of those companies have worked to push down and enlighten the risk understanding of the organization. Now, in a larger group, like you folks have, where you have the advantage of a risk management department, I think that department plays a very interesting role because those of us at that first line are really focused on individual occurrences and almost anecdotal activities around risk. But a risk department is staffed with bright people with statistical backgrounds, with understandings of modeling, with understandings of how to communicate, and can gather that information into a usable tool, which allows you to then communicate up to the board and to the executive. And making that understandable really is the key for a successful risk department. If you're not getting calls for your help, then take a look at how you're presenting it and the simplicity of the understanding, so that someone like me can get it.
I had a question received here from Diane Huey at Prodemni. So in risk assessment, do you consider historical patterns of risks or merely just forward-looking risks if the historical pattern has been rectified? Daryl, we have you on video, so if you could kill your video, that'd be great. Thank you. So I'll throw that to the panel. With your risk assessment, are you looking historically at risk, looking backwards, or are it strictly looking forward? And if you've corrected a problem, it's in the rearview mirror, it's done. What's your approach?
Well, I'll jump in and say that all data is useful data, and we're not going to throw away data that we've gathered, even if it is an illustration of our inaccurate assessment of risk at some point in the past. You want to have your models as fully populated as you can. You do want to be looking prospectively, obviously, because you're taking new risk on, but you always want to rely on where you've been to help guide you going forward.
And I think I'd add to that even if a risk that we previously had successfully mitigated or managed, or felt we had previously mitigated or managed, I think it's such a dynamic environment, and certainly for particular risks in cyber or data in that particular area, that there's the chances of your risk not having evolved and changed shape, and therefore needing to keep a regular look at in terms of how effective your controls are, but also how you are thinking about that risk, I'd say are pretty slim. So I think we spend probably too much time looking at our existing risks and how we manage those. And I'd like, as I said before, I'd love to spend more time thinking towards the future and external risks. That's just a feature of where we are in day-to-day business life at the moment. But I think that it's always going to be a blend of the two.
Yeah, and I would agree with that. I think, as you were just mentioning, there's always the risk of looking at what's right in front of us, the urgent versus what's important, and it's always important to balance that out. But yeah, a comprehensive look forward and backward is required in my mind.
Everybody's going to be involved in this in June. We're coming out with our biannual enterprise risk management survey. And one of the questions we ask in that survey is, how often are you engaged with senior executives in the organization and your board? And we found that smaller companies have really trended towards the patterns with larger companies, really mimicking the best practices of larger organizations, that people at the grassroots level, more and more, they're digging deeper for engagement with the board of directors. So this question, how do you normally report emerging risks to executives in your organization and the board? And is this part of a periodic risk status report, i.e. quarterly, or as part of annual strategic planning discussions? So how often do you engage? Are you engaged right now with the very, very senior team and the board, and how often is that taking place?
Yes, and heavily. So yes, so I mean, for us, it's emerging risks is part of our quarterly reporting. It's part of my CRO report that goes to our management risk committee and our board risk committee. We try to visualize it using a graphic rather than having too many words, because there's a lot to cover, because it is such a wide environment. And it tracks around, and at the moment it changes over time. It depends on what's going on in the business at the time. But at the moment, it's attracting a good amount of the discussion time that I have to talk through the CRO report. There's a lot of interest from the senior management team and from board members as to what's on the risk spectrum, and to contribute their thoughts and ideas. So yes, quarterly, and yes, as part of the strategy and planning process. For me, strategy and risk are two sides of the same coin. So as part of the preparation for and the discussion in strategy setting, and then that leading on into the planning process, risk is heavily involved with management and then the board in terms of those conversations.
Yeah, and for us, I'd say it's primarily annual around the strategic planning process, and then the outcomes of the work feed into both the annual operating plan and strategic planning process, as well as integrated into our ORSA report. This year was probably a little bit different in that we did it twice. One was our standard emerging risk report, but this year we also looked at COVID-19 and its impacts across all the lines of business, and it certainly seemed to be accelerating some emerging risks, whether that be future of work or whatnot, and making sure that we were considering that. Digital would be another area. It's not really emerging, but obviously accelerating a risk there in terms of if you're not ready. We do have an Erm Dashboard report, though, that we do quarterly. It's sort of articulating our risk profile. And we actually have recently talked about whether we integrate the emerging risk a bit more into, maybe it's not a detailed analysis, but at least we're getting it on the radar quarterly rather than annually, which is a bit more timely.
Yeah, you mentioned small companies becoming much like large, Ian. And so, yes, when I acquired the company, we put in a new board of directors, and we're very fortunate to get a number of seasoned financial people from the audit, the legal, the C-suite to join the board and provide some guidance on it. I speak with them, I guess, usually once outside of board meetings. We have some sort of call or interaction to talk about what's happening. Rare is a call that goes by or a dinner that I'm not asked by one of them what my chief concern is at the moment and what are the risks that are keeping us awake. They may also ask about whatever risk appeared in the most recent McKinsey email too, but they're a pretty good group and very eager to participate in that risk discussion.
Here's an opportunity to throw questions back from the panel to the industry. We had a little chat, our panel, prior to this, about what's a good working definition for emerging risks that we could use to kind of level set the discussion that we're having today. And the panel agreed that an emerging risk is an accelerating risk where the outcome or the implications or implications are not known or clearly assessed and or where there's not appropriate ownership or classification of the risk. So everyone out there watching right now, do we have it correct? Is the panel, is that a good working definition of emerging risks, or what do you employ when you think of emerging risks as it suits your organization? What definition are you using? Just give a minute here for people to offer up questions or comments on that. Is there anybody out there that wants to venture a comment?
Is there anybody else?
Does our panel have it correct?
Sure. This is Jason Kiefitz from Trisura. I think it depends a little bit on who I'm talking to, whether I'm talking within a risk team, like within a risk function, or if I'm talking to, our executive team. If I'm talking to our executive team, I really try not to get hung up on definitions. It gets a little bit academic and it confuses people. So I think that working definition is fine. It's very complete. It's kind of like anything that we haven't talked about explicitly is emerging. So, to me, that's that's a perfectly fine way to approach it. And if you try to get too caught up on definitions, I think that it's just going to confuse, especially your non-sort of risk management colleagues.
I think that's a great point, Jason, because I think there is something about the sort of the language that, you know, that functions can put on things that then place barriers in an organization and in a conversation, when actually all you really want to get to the heart of is what's worrying you, what's a concern, what are you seeing emerging as a trend that we should be thinking more about. Whether you call it an emerging risk or an extenuating risk or an exogenous risk or whatever, it's not going to help that conversation, is it?
Let's go on to a question about specific risks. I'm going to throw this to John and Maz, and I have a follow-up question asked to Andrew. So for John and Maz, how would the panel, how would you two assess the current state of cyber risk to clients and insurers? Are the risks well understood? Are insurers responding to provide the right solutions?
Maz, would you like to open, or?
Yeah, happy to. So I think, I mean, cyber risk and the related risks that sit alongside it with data, it's extremely dynamic. It's such a wide-ranging threat, and it's changing shape so quickly. And in part that's because of the sort of the number and the sophistication of the threat actors that are out there, because it's potentially very lucrative for crime. So it's always going to continue to attract people into that industry, as it were. And for me, the challenge with cyber is that it is extremely wide-ranging. It's more than the impact to the company, its impact to supply chain and their business continuity and how that affects us, its impact to our distributors, to our customers, of course, in terms of, you know, struggling under the weight of a cyber attack, and particularly if you've provided cyber insurance. And yes, also to our industry and regulatory bodies, as we've experienced in the last few weeks. So, you know, I think the main challenge here is of aggregation risk from cyber, because it's, you know, an event can simultaneously impact across, you know, all of our insurance coverage and our partnerships, but also across a number of the risk profile elements. And in a doomsday scenario, you could see insurance risk, customers, distribution, operational risks, financial systems suffering all at the same time from one very well coordinated and sophisticated attack. So you know, the aggregation risk across the risk profile to the organization is something that, yes, does worry me in terms of, have we truly understood it, or are we looking at it too much in the individual silos of insurance risk, operational risk, financial risk, etc. And then beyond that, we've got just the global contagion risk, you know, the potential for an international simultaneous impact as a result of one event. And prior to last year, to be honest, I thought that was probably going to be the first time we would see a truly global contagion event. And I learned a lesson last year with COVID, obviously. But, you know, the management of that aggregation risk for a global operation, or one that is reliant on supply chain partners or is impacted by what might happen elsewhere in the globe, I think is a real concern. Are the risks well understood? I think if you're providing cyber insurance and you've got and you're clear and you've got tightly aligned intent and wording, and that you've incorporated expertise from your IT and cyber experts as part of the development of that product, then, you know, you're probably at the point where you're as well understood as you can be. But to be honest, for me, the data and the modeling of that risk just isn't there to be fully confident that we really truly understand that risk. And it is a massive challenge, because society needs that element of coverage, increasingly so nowadays, and insurers are there to provide solutions to society. So the concern I have is, how do we properly assess and measure the level of risk that any one particular customer might pose to us, without extremely invasive investigations into the quality of their security system. So, it's a really challenging product to sell and to manage. And I think it'll have to evolve from a very tightly controlled and limited start point until we have enough data and modeling to be able to then properly, well, not properly, but better understand the level of risk. I'll probably stop there, John. I'll pass over to you.
Well, I probably would have been much less erudite, Maz, and just said that understanding the magnitude of cyber risk is extremely difficult for all the reasons you've outlined. The thing that's really interesting to me about cyber risk, of course, is that it's to a large degree a people risk. Certainly,
absolutely.
We have denial of service attacks. We have hackers through back doors that have been left open and that sort of thing. But a lot of the attacks and the occurrences of attacks are based on people taking actions, and it's hard to prevent people from doing things that they feel they're doing a good job by doing. And to give you an example of how difficult that is, I look at Navalny, the Russian opposition leader, who was, of course, poisoned, and his team then went on a fishing expedition into the KGB and got them to admit that they, in fact, had poisoned him. And just think about that. Here is a group in the most paranoid country in the world, filled with the most suspicious minds, and they were still fished.
Yeah.
So in our customer service oriented culture, with our staff who are breaking their backs trying to do everything for our customers and to do it quickly and do it in real time, I'm not sure what kind of ultimate hope we have. So it's got to be a multi-layered response to the cyber, because if the KGB can't protect itself, and of course, as we saw with the other hacking scandal in the U.S. government a few weeks ago, if they can't protect themselves, then our customer service cultures and their people are certainly vulnerable to cyber and cyber attacks.
Okay, fair point. So another specific risk, cyber was very top of mind for a lot of folks out there. Also automobile insurance. What risks, Andrew, I'll throw this question to you. What risks do you foresee in continuing down the path of the current auto insurance products in Canada? What are you seeing from your company perspective?
Well, I think ultimately the risk is that the product becomes unaffordable or unsustainable in some provinces, which is, of course, very concerning. But I do think it is promising to see a lot of governments are listening to stakeholders and open to reform. We certainly think there's significant improvements that can be made to improve stability in the system while reducing costs and improving benefits and delivery to policyholders. It could be improved choice, faster access, care, market innovation, higher proportion of premiums going actually back to the policyholders. So we're very supportive of reforms, but the risk is that it becomes unaffordable, and that would be really cause some disruption in the market.
And no questions on that. I've got one eye to the list of participants just to see if anyone is questions or comments are invited throughout the broadcast. So please don't be sitting on your hands. If you have a question or a comment related to some of the questions I'm throwing at the panelists, please put your hand up and you'll be recognized, and we'd love to have you join the discussion.
Ian,
yes.
One of the things I was going to say is on cyber risks is I'd be really interested in the thoughts and the observations of the attendees is to whether, as an insurance industry, we are providing or thinking broadly enough about the right type of solution here, because I think one of the things I've been quite curious about is whether what would be more valuable to our customers potentially would be some form of a package solution that brings advice and consultancy on prevention, backup of systems and data, so that it's recovery is much smoother, rather than it being rather than thinking about that after the event. and support and handling any particular cyber event. And then insurance, should you encounter financial loss or penalty as a result of what's happened. I just wonder whether there's more that the insurance industry should be thinking about to develop some of these solutions, because whilst it might be easy for Aviva to have an extensive IT and CISO department to support itself, to support and look out for these particular events, it's not the case for the vast majority of our clients out there. And I wonder whether we should be putting more effort into putting together a solution in that respect, rather than simply focusing on traditional insurance. I'd be curious to hear whether anybody's seen anything like that in the market. I've yet to scan it fully for that, but whether it's something that we should be thinking more about. So I'll put it out there. Maybe somebody will put a comment up.
Okay. I do see a comment here came in. It's related. It's kind of tying together both cyber and car insurance. So here we go. Do you see cyber affirmation or exclusion being a product that automobile carriers will be looking for in the near future? Who on the panel wants to grab that one?
Well, to the extent that we're going to be having, we do already have far more connectivity in our vehicles, and in particular as we move more into telematics space, then there is the risk of cyber impact to your vehicle, but also the data that you are collecting as a result of driving your vehicle, and what that might tell you, what that might tell others about you, and therefore release, effectively highlight something that previously might not have been thought of as, PI or private information, might then be something that could be used as private information. Then potentially an auto insurer might not want to be exposed to that risk. And so, yes, cyber exclusions may well start to appear, and therefore, as a result, the potential for a cyber product to be developed alongside that is out there. That's my thought.
More and more cars are becoming connected. I mean, I have a minivan that's connected to the internet of all things. So as more and more connectivity comes, and you just heard about the risk of cyber and sort of the pandemic related risk. Well, just think of what that would be like for the industry if there was a pandemic related cyber attack on a whole bunch of connected vehicles. It could be disastrous. So we really need to understand that risk. Yeah, I think it's something that really needs a lot of exploration. And for now would be we take an exclusionary approach, I imagine.
It's an interesting little segment of the show right now. We're getting questions on very specific risks. So here's one that came in. Should insurers invest in cryptocurrencies as part of their investments for additional diversification? If not, then why not? And if yes, then how would one assess the risks for this type of investment? Given the fact that Bitcoin is going through the roof, or it's gone down a little bit lately, but with Tesla investing so heavily, maybe it's becoming legitimized. What are your thoughts on that?
I won't tell you what our conclusion was, but I will tell you that we did talk about this because some of you may have seen companies like Mass Mutual invested over, I think it was 100 million US into Bitcoin. So we've had the conversation. I think that at this stage, I think it remains to be seen what would we really get from that from a strategy perspective. I think there needs to be a compelling answer for us before we would do that. And so why would we, is there a real benefit to us allocating a small percentage of our portfolio? And so why would we do that? So I think I think we want to see the industry or the environment develop a bit more on this topic. It's still, you still see wild swings. Why do we really question whether we would want that volatility? So it's something we're continuing to monitor. It's certainly the Bitcoin is gaining more acceptance, but it's something that we're, I would say, monitoring.
I think the the thing that I'm quite interested in is the effect of social media on some of the sort of the cryptocurrencies, but also as we've seen in recent weeks on particular stocks. So the sort of the Reddit community, and I think was it GameStop? I can't remember exactly what it was. in terms of the asset that, you know, a crowd effectively collated to then drive extreme volatility in terms of the value of that asset. And, you know, and so to the extent that crypto, you know, Bitcoins and cryptocurrencies are more susceptible, or at least more attractive to that sort of level of savviness, but also potential for crowd impact, is something that at the moment I don't think we fully understand enough to feel confident that we can understand the drivers of the volatility behind that particular asset class to warrant investment at this point.
I see Alistair has his hand up, so maybe Alistair, you want to join in here? There we go.
Yeah, maybe precisely to this question around social media and how it connects with kind of the pace of play. And I guess what's not long before lockdown, I was at a conference in Basel, Switzerland, and a lot of bankers, gloomy bankers, banking supervisors, were talking about how they would normally approach the liquidation of a failed bank. And the traditional process would have a Friday at 4 o'clock, and they would go in, take things over the weekend, find out how much trouble they were in, and then there would be a press release on Monday morning and a court hearing somewhere where they seized control. And so then they had a presentation from some Hungarian central bankers who were discussing how that didn't work in their most recent failure, where the bank failed, but by 4:05, people live streaming the bureaucrats arriving at the bank. And by midnight, there's a mob outside the deposit insurance building because there were rumors on Facebook that if you didn't get in line early, there'd be no money left. And as a result, the team that was ready to go work all weekend couldn't get into their offices. And so this idea of pace of play and all the rules changing. Yesterday, I was on a webinar at GRI with the CEO of Wealthsimple, who described, you know, suddenly having the most popular app in Canada on App Store or Google Play, and 1 million new clients in a week, all of whom wanted to speculate in GameStop. And so you're just aware as risk professionals that the process is speeding up. I guess I'm curious from all three of your perspectives, small and big company, what are you doing to be faster?
The insurance industry is normally lightning quick, aren't we?
Well, honestly, you know, cyber is probably the first substantial exposure that had to have its own new class of business created. And I don't think it took us more than 5 years. That's not bad for us. But I mean, it's property and casualty. I mean, it's stuff's been around for a long time. Cyber was pretty new. But the types of exposure, the pace of play just keeps picking up by an order of magnitude. And I think, you know, risk professionals are aware that it's scarier and riskier out there. But what can you do within your own organizations to be more alert, faster to respond, I guess is on my mind.
Well, I would say we're still working through that. I mean, the good thing is that it's actually one of our top risks is the ability to, you know, execute fast and changing processes, and that takes time. So I'd say there's excellent awareness of this risk and the pace of change. As to how do you actually practically solve that, I would admit it still remains to be seen. All the strategies we need to deploy to do that. So we're working through that as an organization as we speak.
Yeah, and we're not. I wouldn't say we're doing much. We're doing much better in that respect, because I think, you know, there's a recognizing of the changing risk environment. There's a flow of that through into, is that a conversation about something that we want to manage as an organization, and, you know, the control structures that we might want to update. But there's also that conversation about, is that an opportunity in terms of developing a product and supporting customers with what they're also facing. But we are, as an industry, very reliant on our historic information and our trending to support us with pricing and with underwriting decisions. And it's very difficult for that to adapt at the pace that we are seeing right now, without taking a leap of faith, or being a lot more comfortable with the use of ranges and the understanding that there will be volatility that you're going to experience. And that's okay, because you're going to learn during that. And then you refine that process as a result of collecting that data and information over time. But again, over time, it takes a long time. So I think it's always going to be a challenge for us. And we've seen it with cyber, as you say, it's taken us 5 years to get to where we're sort of not are now. But even for some of the other risks, particularly around the changing of vehicles and driving in that space as well, I think it's very, very slow, the pace that we're able to move at.
I must admit, I was sitting here thinking about going faster, and so 20 years ago launched North America's first fully underwritten term life policy that could take you from signing on to getting up to $500,000 of coverage issued online in 15 minutes. So, and certainly when I purchased this company, Fenchurch General, it was to some degree a traditional insurance company. And I purchased it for my InsurTech investors at Besurance Corp, who build technology for insurance companies, and were having trouble getting it adopted, so decided to buy their way into the industry, which is always a good approach. And as part of that, so the first year I spent automating everything in sight, scanning all the old docs, moving all the processes to the cloud, eliminating paper from the office, and moving everybody to Teams so that we could communicate more rapidly, and Slack as well initially. So when March came, it wasn't a matter of changing process. It was just calling everybody and saying, yeah, don't come to work tomorrow. We're going to be virtual. So, and we've just continued with that. So decision making, absolutely, decision making could always be possible for all the reasons Maz outlined. If we can print it on paper and it looks good as a graph, we'll take that into consideration. But at the end of the day, decisions do have to be made.
I'm going to throw this question to Maz and to Andrew. As an industry, what role do you think we play in climate change, given the increasing frequency and severity of natural disasters? What's the insurance industry's role in combating or addressing climate change?
Of course, it's a huge topic, and one that is very, very proximate for the industry and for individual companies at the moment. I think there's multiple angles that an insurer, or multiple opportunities for insurance in this space. I think if I sort of chunked it up, I'd be, there's definitely a lot more that we can do on education. I think that, while there's still a lot more that we need to do and we could do to improve the modelling of climate risks, whether that be flood or wildfire, we actually know a lot about risk from the models that we have already, and these are the risks that our customers are facing every single day. And we will use that information to support ourselves with pricing and underwriting decision. But what more could we do to actually support our customers with understanding their level of risk by sharing and educating them with that, so, elements of that information themselves. So I think there's an opportunity for insurers to play a more proactive role for individual customers. And I think that extends to real-time information when we're receiving weather alerts, and making sure that we're contacting our customers to remind them that if a storm is approaching, that they might want to wrap up the patio furniture or take something off the balcony. So there's the education side, and then there's prevention. I think there's as an industry, we are a large group. We have influence, and I think there's we have a responsibility as well to support with lobbying activity on flood defence, better home build resilience, and drainage around high risk flooding areas, and or fire breaks even in homes that are in very densely forested areas or very dry. So I think we have a role to play in prevention around supporting lobbying activity. Obviously, there's the obvious point of protection in that we insure, and so when the event does happen, making sure that we are there to support our customers on the ground as quickly as possible, and building back better, so that there is more resilience built into the system, such that the impacts of climate change are only going to get more volatile and potentially more severe over time. And so I think it's our responsibility that when we are going back in after an event, that we build some of that resilience in as part of the solution that we provide to our customers and people who've been impacted. I'm really interested in, obviously we are big investors and we have large asset base, and clearly there is a role for us as large investors to push for change, where that makes sense through whether that be divestment in climate harmful initiatives or active investment in climate beneficial innovation. But there are multiple challenges in that space, whether that's direct investment or even activity in our underwriting space. It's we need to allow for the appropriate time for transition of markets and economies to rebalance their activities to support a more climate safe world going forwards, and so there's a balance to be struck in all of that activity.
Yeah, and I'll just add to that is, in line with Mark Carney's tragedy of the horizons, we're definitely on board with that. We see the severe damage and disruption to the global economy if we don't get a handle on this, and if we wait too late, it may be, if we wait too long, it may be too late. So we at Cooperatives, we really think it behooves insurers across the board to do our part in highlighting the significance of the risk, particularly given that we're in the business of risk management. So, I mean, whether it be our position as risk managers and experts, getting out there in the media, in the news, and whatnot, to ensure that this issue is, that we're taking action on this issue across the board, both through the government and through industry. We're risk carriers as well, so we should be leveraging our balance sheet, whether it be the liability side in terms of making sure this is well known through products and doing what we can there, as well as on the investment side. At Cooperators, we are heavily into impact investing and transitioning our entire portfolio into sort of a climate action oriented one, and hopefully work towards some of those 2050 targets that are being set out there, and so we want to be part of that. So again, I think it really behooves this industry and specifically to take a huge role on this risk, not just with their clients, but for society in general.
Okay, and if anyone has questions or comments they want to add to this, certainly do put up your hand and we'll bring you into the discussion. I'll throw another question to John. John, are you concerned about, and if they want to join in as well, make this a free-for-all, but John, are you concerned about judicial social expansion of insurance contract wording, i.e. covering risks such as cyber, pandemic, ransomware payments, etc.? Is that something that's a top-of-mind concern at Fenchurch?
Not necessarily a top-of-mind concern, Ian, but I think all of us in the industry are concerned about the expansion of our contract wording, or the interpretation of our contract wording in ways that were unanticipated. It certainly is something that we get very little control over, and often the decisions are made by judiciary who aren't necessarily familiar with the insurance terms being used. And so we have had a recent experience actually where wording around a piece of language was changed. It wasn't a substantial change, but it's always interesting when it happens, because you're sitting there looking at it thinking that it was very clear and straightforward, but some judge on the advice of their peers or whoever is in front of them has taken a different interpretation. So yes, it's a concern. I mean, it comes back to that whole people concern about risk. All risks to some degree come down to people and the decisions they make, and what your exposure might be to those, if that's helpful, Ian.
Okay, and the others, do you want to jump in? No?
Well, I would agree with John as well. It does come down to people, because I think one of the challenges that we face in the industry is about how we make sure that our wordings are appropriately clear and not 100 pages long, but such that people actually read them, they understand their coverage, and they're not put off by the sheer length and small print wordingness of it. But at the same time, sufficiently cover the actual original intent and not leave the sort of the room for the potential misinterpretation or loophole around what was never intended to then emerge later on. I think that's a really difficult balance, because you can't, or it feels very difficult to achieve both. Make it easy for people to understand, but also make it sufficiently complete that it doesn't lead to an emerging risk later on. I think that's something that we're going to see more of, not just because of the judiciary system, but also the potential for pressure on reputational risk. Again, I don't want to keep harping on about social media, but the extent to which the society expectations and the ability to group together and bring pressure, or at least to lead to quite harmful reputational damage as a result of commentary in the media as well. I think that is another area where companies are having to make a risk trade-off in terms of what was intended versus what would be the ultimate cost, and that ultimate cost being a combination of reputational, financial liability, or even the operational cost of being able to support the claims that you might never have intended to have covered. So I think I do think this is very difficult, and it's going to continue to get difficult.
Yeah, and I guess for my part, I mean, I take comfort that Canada and the rule of law is pretty well established, so I think the risk is a little bit lower. But I do think 2021, 2022 will certainly be interesting years to sort of watch, particularly as our industry results come out, and there's various aspects of what we call the K economy, the losers and winners, and how that plays out in terms of political pressure and whatnot. So I think it'll be a challenging year, but I do think Canada is a pretty good place to be on that front.
Let me follow up, Andrew. I have a question for you, just going through the rotation, a very specific one for you. Can you provide examples of top-down versus bottom-up approaches that you currently use to identify emerging risks? Everybody out there wants to become much more proficient in identifying emerging risks. What are some bottom-down or top-down and bottom-up approaches that you take?
Yeah, I think we kind of touched on this at the top of the conversation. Like I say, most of our processes around that are manual, in the sense of that we're setting up meetings and talking about it with various departments and business units to gather information. And I think that's obviously an important approach. It's not so much top down as well, though. I think ERM really brings that independent view and gathering information from external sources to bring that as well. And then usually once we put that all together, will go in front of senior management and present on that and get their sort of top-down views on things. So it's really an integrated approach through a lot of conversation. That's really, I would say, that's our main approach to things.
Okay, let's go to Maz. Maz, what advice would you give risk managers in identifying the root causes of a risk rather than confusing them with the symptoms of a risk?
It's not going to be groundbreaking advice, I'm afraid. I'm probably going to just revert to what we learn from our children, really, in terms of how they ingest confusing information. But really, it's about asking why, and about asking it about 100 times. I think for me, the why is more important than the what. In respect of, either a risk that you're thinking about proactively or after an event, because I think the what drives you into the symptom, rather than, if you're asking why, then I think you're heading into, why has this thing happened? Why has it evolved in the way it did? Why didn't the system support it? And I think that helps to get into the skin of the underlying root cause, rather than getting too caught in what actually happened. And I think for root cause, it's about understanding and looking at the system around the particular risk or the particular event. If it's crystallized, it's the wider system and process, which is where I think you'll then be more successful at being able to then truly identify what is the root cause. And I'd probably go 80-20 on that, even in terms of 80% of spending my time looking at the process around the risk and the event, rather than the actual thing that happened. And I do think it's helpful to park at the door, or the virtual door, the perception that the risk is type A, right? It's this particular risk that's happened, or this particular risk I'm worried about. I think if you go into those conversations with the full risk profile in your armory, you keep an open mind as to actually what the actual cause may well have been, rather than what we perceive it to be. I think there's quite a lot of potential for human interaction in that space to cloud what is actually going on. I think it's an absolutely fascinating part of our work, and I find it very rewarding to have a good, constructive, transparent conversation about root cause, because it's about proactively looking about it not happening again. And by avoiding blame or the should haves, and focusing on the observation and the could do, I find that I just find that a very interesting part of the risk management cycle, and certainly helps us to interact and engage much better with the business as a result of taking it in that light.
Okay, another targeted question. John, I'll throw this one to you. How does responsibility for identification of emerging risks get split out between the business, the first line, and risk management, the second line?
That is a good question for a small company. And so, as I think I mentioned when we were talking at one point, for me, every risk is to some degree an emerging risk. Having acquired these companies, when you go in, it's turning over the rocks and finding what might be there in terms of risks, and trying to quantify and put in mitigants to control those risks going forward. So in all cases, wasn't lucky enough to have, in fact, a second line of defense. And one of the first things that I do is to start to engage second line of defense to help to monitor, well, first of all, to put in place policies and document processes and get controls around the risk, and then to start to monitor and work with the first line of defense, the business unit, in terms of understanding the risks that they are taking on, and work through them. So it's very interesting, and you know, it excites the people when you start to introduce risk management and looking at the pieces, because they haven't had the opportunity to step outside and consider risks as a holistic thing. It's been, you know, can we write this policy? Is this asset any good? Is the fact that we don't do looking at our office space for contaminants a problem or not? Now that you bring in that process and start to work through it, people very much enjoy at the front line looking at the emerging risks and what's there, and the second line of defense does a wonderful job of then helping to structure the thinking around it, put in place the policies and the processes to deal with it. A different experience than being at a very large company where a lot of that is in place when you arrive.
Okay, we have time for a couple more questions. We're very closely tracking towards 2:30, so I'll just sneak in a couple of toss-up questions for the panels. This has all been about risk identification and assessment. So once emerging risks have been identified, what do you do with them? What's your strategy for advancing them further with research, product opportunities, etc.? So we've gotten past the identification, but what now? What do you do once a risk has been identified?
Well, I'll jump in, and I'm going to key on one of the things you said, which is how do you monetize a risk? So if there is a new risk, and so when COVID started to appear on the horizon in January, my colleague had just returned from China, and we had already had some conversation around what was happening, and we started to look at, was there an opportunity to introduce some sort of product for short-term sick coverage or single payment if someone did have a positive test. Now, the fact of the matter is that all went away once the government jumped in and started to pay people a lot of money. But it is when there is an emerging risk, as well as looking at how do you control it, it's also worthwhile to look at how you monetize it, as a couple of, as Maz and Andrew have been saying around the cyber risks and the opportunities there.
Yeah, and we try to work with our VP, sort of at the VP level, to monitor as part of the second line oversight processes. And so we would assign some of those emerging risks to the first line, or at least work with them and create a log and then check in with them on a regular basis. And then as it moves from emerging to more proximate existing risk, that's when we would try to make sure we're taking advantage of any opportunities. So whether that be something like cannabis, making sure that we're ensuring that it gets written into the products and our underwriting approaches. Big data was another one, as we kind of identified that early as something that we wanted to make sure we were on top of, and that there could be future talent risk and getting out segmented in the market. And so we use that to work with the P&C teams to start to build out a BI department, and we've continued to build on that through to this day. So those would be some examples.
Okay. And Maz, okay, I'll just go on to the next one. This will be our last question, and then I have some things to wrap up for the session. But for each of the panel members, in your career, what emerging risk was the most difficult for you to get your organization to take seriously, and how did you do it? Is there one that jumps out at you top of mind that it was difficult to get eyes on it?
Well, I'm new to the role, so I haven't had that too much of a challenge. I'd like to say that in January I raised the pandemic risk, and but alas, I was probably sort of as surprised as everybody else at how much of an impact it had to us. So I would say the big, if I were to speak to our organization overall, the thing that took a while, even within cooperators, where sustainability is a big thing, was getting traction on climate change, and that started a long a long time ago. I think the way that we did that was we started building into compensation plan considerations. We made sure that we got involved in various initiatives that are going on around the industry. We made sure that we were promoting it across the group, and over time that built it into I'll call it the climate risk culture of our organization, and now it's just part of what we do. So Addenda, which is part of the cooperators group and manages all of our assets, they've built that into their processes, coming out with impact investing products, climate initiatives related to the equity products as well. We built it into our products and into operational processes. So I guess that would be the start, but it was still difficult from the beginning. But it does show, once you build it into your culture, how much traction and action you can get out of it.
I think I'd have to go with pandemic, because it's something that we've had on our radar for some time, and we've been looking at it as part of our emerging risk, our emerging risk modelling for some time. We're part of a group that is covered under Solvency II, and we have an internal model as part of that. And we've had that as considered within our internal model for some time. But even in late January or early February, in fact, as I was flying home from London, or flying back to Canada from London in early February, just at the point where the company was starting to worry about its staff flying between countries. But even at that point, that conversation internally in terms of what could this do, how should we prepare, how do we need to ensure that we've got the right understanding of potential exposures across all of our risks, we're still fairly slow to get moving. And I think how did we do it in the end? Well, I mean, to be honest, it became a risk, didn't it? So and unfortunately, that's one I would like to go back and replay and think through, what could I have done earlier, and what could I have done with more vigor to have preempted us, even better. We didn't do badly in terms of being able to respond quickly as an organisation, but what could we do better? And using that scenario to then replay and look for the potential for that to impact other types of emerging risks sitting on my spectrum, and asking that question of, so what could I be missing that I missed when the pandemic kicked off?
I may take a bit of a reverse lens on it. I think a lot of my successes have come during periods, and a lot of my acquisitions have come during periods of risk change. And so I think about the Mexican peso crisis. I think about the 2001 9/11, and then the internet bubble almost at the same time. But the one that comes to mind most of all is the 2008 mortgage crisis. And on the day that AIG declared itself to be in trouble, I called the acquisition team and said, I want to buy their Canadian business. And of course, people said, you're nuts. We're not spending any capital anywhere. So that it took some time to explain what the risk was, why this was not going to be subject to the concerns that were being raised, and work people through the risk profile to be able to get in there and make a successful acquisition, even as the entire capital market was in a state of freeze. And thank you, Ian, as we go to your wrap up, and thank you, Alistair and Danica, for this session. It's been a real pleasure.
Perfect time to wrap up, and thank you, panel. This has been a really insightful discussion and very valuable for the industry. Our panelists have been Ms. Bown, Chief Risk Officer for Aviva Canada Inc., John Lewis, Chief Executive Officer for Fenchurch General Insurance Company, and Andrew Yorke, Vice President, Enterprise Risk Management and Chief Risk Officer for the Cooperators Group Limited. Very interesting this week that Perseverance landed on the face of Mars, and we got to kind of look in the background and look over the shoulder of the lunar lander and kind of see the surface of Mars. And I invite everyone to look over Andrew's shoulder. because that's what an office looks like. So we haven't seen an office in a long, long time. So it's really interesting to kind of just to kind of look and get the lay of the land in your background. So thank you, panelists, for being part of this. And I'll now ask Danica to please let's put up the slides. This is what everyone can look forward to. I'll be issuing this an invite to this tomorrow. So it is our April 1st Risk Officers Forum meeting, and very, very pleased to have Jacqueline Friedland, Senior Director of PNC Insurance Group, the insurance supervision sector at OSFI. She's going to give an update on current industry issues. So we're in this rotation now that generally in October, November, December, OSFI has an annual risk management seminar, and they outline risks they want to talk about in the industry, top of mind. And this is their 6-month check-in point. It's become kind of an established routine. And we're just delighted that she's going to be our keynote speaker. And then we've got a couple of very interesting panel discussions. So the first one is with Anya Sriskanda-Raja, Managing Director at Guy Carpenter, and Sean Russell, her colleague, also Managing Director at Guy Carpenter, and Craig Pinnock from our industry, CFO for Northbridge Financial Group and Chief Agent Tokyo Marine and Nichito Fire Insurance. They're going to be talking about rationing and allocating capital for earthquake risk. And in the second hour of a panel discussion, we're going to have Jimmy Jean, macro strategist for Desjardins Insurance Group, Michael Cook, Vice President of Client Relations and LDI Client Portfolio Manager, CIBC Asset Management, and Gaurav Deeman, Portfolio Manager, Global Fixed Income from CIBC Asset Management. They're going to be talking about the risk of long-term low interest rate or long-term low interest rates and the concerns our industry has about that. Following that, in May, mid-May, May 19th, is our next Emerging Risks webinar. And we're going to have another panel. Carl Lucier, Assistant Vice President, Personal Lines Projects, Economical Insurance. Alison Slater, Senior Director of Sustainable Finance from the Global Risk Institute in Financial Services. And also Aaron White, Client Portfolio Manager, Equities from CIBC Asset Management. They're going to be talking about ESG scores and the implications this has for investments and underwriting in the industry. So that is very interesting, and we certainly encourage your participation in that. I'll be sending you tomorrow, along with the invite. Everybody in the broadcast today will be sent a satisfaction survey, and we welcome your feedback. We want to enhance the quality of future broadcasts. We invite your thoughts on future speakers and subject matter. If you want to be a panelist in future in one of our sessions, we'd certainly be delighted to have you on board. So I want to thank everyone for joining us today. This concludes our meeting. We look forward to having you join us for our forum meeting on April 1. Do watch for the registration package coming shortly. And in the meantime, stay safe, and we'll see you soon. And goodbye for now. Thank you.
Thanks again.